this point, the selling has gotten so bad and so indiscriminate that I think you now need to be ready to hold your nose and buy something on the way down, as we did in a small way for the charitable trust this week, talked about this morning, where we put some of the money to work that we had sold earlier in the week. But I know it's very difficult to get enthusiastic about new ideas at a time when it feels like the market's doomed to go lower every day, right? Doesn't it feel like? So that's why tonight I want to catch up on some homework. Remember, this is the most interactive show on television, albeit maybe only by the standards of 2005 when we first went on the air. Whenever you ask me about a stock and I'm not familiar with it, I don't just say, hey, I like that very much. I say, no, I'm going to take some time, research, and come back, consider a response. I don't like to cut things. Tonight, I've got two of them that are right at the center of the squall of selling that's engulfed the entire market. A pair of post-SPAC names that completed their mergers last year. This is the blast zone. I think most of the SPAC stocks are just untouchable. But every now and then, you'll find a quality company that might be worth picking it into weakness. You always got to do the homework, so let's get to it. On December 21st, right before we broke for the holidays, we got a call from Mark in South Carolina, who wanted to know about a company called Nautilus Biotechnology, which came public by a merger with a SPAC last summer, like so many others. Now, the Nautilus deal was announced in February of last year, right at the height of SPAC mania. So the stock actually exploded higher on the news, doubling from 11 to 22 in a single session. Everyone was excited. But like so many other SPAC names, it's been all downhill ever since, especially the last few weeks. At the point the stock's trading under 4. This one's barely large enough to talk about on television. It's crushed so many people. So what the heck does Nautilus Biotechnology do? And is its stock worth a couple of bucks here? It's kind of like a Powerball ticket, isn't it? These guys are working on a technology platform that will, in their words, unlock the complexity of the human proteome. If you're asking yourself what the heck is the human proteome, you're not alone. We asked ourselves what the heck is the human proteome, and then we had to look it up and do study. It turns out these are a set of proteins that control cellular functionality. Unlike your genes, though, the proteome is constantly changing depending on your diet and a host of other factors. That makes it notoriously difficult to study. Here's where Nautilus comes in. They're trying to create a platform, think instruments, reagents, software, that can take in proteome samples and return unique biological data. The ultimate goal is to create better individualized treatments for all sorts of conditions, kind of like immunotherapy. The analyst who covers this industry for Jefferies likens it to the DNA sequencing space roughly 20 years ago. Now, that only gave birth to all sorts of huge biotech winners. That intrigues us. The thing is, this story is very much in the earliest possible stages. Again, Nautilus isn't trying to study the human proteome. They're trying to come up with tools that are capable of studying it. They want to be an arms dealer to this industry. Intriguing. Of course, I have no idea if we have the technology to study the human proteome or what we could get out of it. But I do know that Nautilus has some encouraging partnerships. In 2020, they signed a collaboration agreement with Roche's Genentech to map and analyze the landscape of a particular protein that they're interested in. Very good partner. More recently, Nautilus has linked a deal with Amgen, too, to use their platform for a number of different projects. They've got research agreements with the University of Texas MD Anderson Cancer Center to help study targeted cancer treatments. All of these are great companies to be involved with. Get this. Over the summer, we also found out that Amazon, of all companies, had taken a $15 million stake in the company. Jeff Bezos even invested in it personally. That news caused the stock to spike up 50%, although the enthusiasm was short-lived. Beyond partners and investors, Nautilus also has some real sponsorship on Wall Street, which makes it pretty unusual for a SPAC name. Since July, 4 analysts, including those at Goldman Sachs and Morgan Stanley, have initiated coverage of Nautilus with either buy or hold ratings. Of course, none of these calls have done any good. If you listen to them, you've been crushed. Honestly. The best thing about Nautilus is that they had $347 million of cash, 347 at the end of September, which is huge considering that this is roughly a $500 million company. And look at it another way. It's a $4 stock with $2.80 of cash per share, no debt. In other words, you're practically getting the company for free here. I like that. But it's not necessarily a reason to buy a stock because they have to burn that cash, and they might even have to do a dilutive equity offering to raise more capital in the next couple of years. In the end, I don't really have an edge on Nautilus. I told you everything I know. But I don't have any strong feelings either way. But even if you want to speculate on a SPAC name that's been de-risked, I recommend waiting because Nautilus is wrong for the current moment. If you think the sound of proteomics, well, let's put it, if you like it, you know who dabbles in it? It's Thermo Fisher, TMO. And it's more fitting for this market. But look, I play Powerball. This could be Powerball. Next up on January 3rd, Stu in Florida called about Cyxtera Technologies. Wow, this one's interesting. Now, this came public by merging with Starboard Value SPAC late last July. Starboard's a good company. Here's a company that was created 5 years ago when the old CenturyLink, now called Lumen, carved out its data center and colocation business, which was always good. I got to tell you, Cyxtera is interesting. Unlike so many SPAC names, this is a real business, significant revenue, actual earnings, at least before you back out interest, taxes, depreciation, and amortization. That's a major reason why the stock has held up much better than its post-SPAC peers. Currently trades at $10 and change, a level where it's repeatedly stabilized in the past. What does Cyxtera do? I say they're a data center play, but more specifically, this is what's known as a co-location provider, also known as a carrier-neutral data center, because they don't force their customers to use a specific telecom carrier for broadband. It's similar to something like Equinix. I like the data center business, you know that, but ultimately Cyxtera used to be a private equity portfolio company, so the balance sheet is still loaded with a mountain of debt, and that's why it's only profitable on an EBITDA basis, not an earnings per share basis. While I like the financials here, there are some other negatives too. Cyxtera leases the majority of its real estate; they don't own it. They actually lease some of the space from Digital Realty. There's a company I like. That seems like a better bet in this environment. It's got a 3% dividend yield. More importantly, there are some large shareholders in Cyxtera who are currently locked up, and I expect the stock to get hit when those lockups end. The two former private equity backers collectively own 63% of the business. Stock sponsor, Starboard Value, owns 10%. They have a quirky lockup agreement. They can't sell until late July, or if the stock goes above 12 and stays there for at least 20 days within a 30-day period. With the stock just under 11, I think that seriously limits your upside, because if Cyxtera ever has a sustained rally, you have to expect these firms to want to ring the register, or at least part of the position. In the end, I like the data center business, but if you want a data center play backed by an activist, I'd rather go with Switch, which is currently getting pressured by Elliott Management to convert itself into a real estate investment trust. These are both interesting. I'm trying to do the work for them, but in the end, you know what? There's nothing like owning a J&J. Mad Money's back in for the break.
Coming up next.
Let's make money together. What do we got?
Cramer's bringing the thunder and answering your burning questions in today's edition of The Lightning Round.
Shepard Smith here. Thanks for watching CNBC on YouTube.